Hi everyone, and welcome to our third quarterly call of 2018. We've muted all of the phone lines. This call is being recorded and will be available for replay by visiting the O'Keefe-Stevens website and clicking on the resource tab and then selecting the value conversation link. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources that are believed to be reliable. The information in this material may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your individual situation. This call is available for replay on the O'Keefe-Stevens Advisory website located under the Resources tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thank you, Carly. And thank you for joining us on the call today. For those of you who are on the live call, thank you for making the time to be a part of it. And for those of you who are listening to the recorded call, thank you as well. As we said before, the purpose of these calls is to inform you on our current thoughts about the market, to share a manageable portion of our investment philosophy, and to relate that lesson to a few of the companies we own. Now, this call is going to follow the same format as previous calls. We'll be discussing the importance of the balance sheet and looking at how that relates to three companies in our top 15 holdings: Weyerhaeuser, FivePoint Holdings, and Tidewater. We also have one pre-submitted question for the Q&A session to review at the end of this call. And finally, I thought it would be helpful to know if you are on the call as a listener, as our software only notifies us of the number of attendees and not the specific people who are attending. So if you're willing to send us a note or a text after you've listened to the live call or the recording, it would help us to better gauge the effectiveness of these calls and help us to work to continue to improve our delivery. I'll do another reminder at the end of the call, and appreciate your help in advance. So market comments. As I sat down to write this section, I was thinking about the most important things to keep in mind when investing. For us, one of the critical qualities of our working relationships with our clients is that we share a long-term orientation. And when we do, we're able to purchase investments and wait patiently for things to work out for those businesses. We've had a couple of rare occurrences when we've aligned ourselves with people where that long-term orientation is not mutual, and it becomes obvious, sometimes really quickly, that we're oil and water. So you'll understand why we continue to preach to the point of keeping a long-term view and why we only want to align with families who share in that belief. Now, when Peter and I talk about the market as a whole today, we recognize that a lot of the focus is short-term in nature. It's an absolute rarity to pick up the Wall Street Journal or any other financial news, or to turn on the news channels and see or hear comments about a business or a sector and what's going to happen over the next 5 years. Actually, we talk about 6 months as considered long-term in the eyes of most financial journalists today. So for us, it's important that we hold our focus elsewhere and look for reliable sources of information that align with our idea of a long-term holding period. So the quote I have on the screen is and always will be relevant to our selection process when designing your portfolios. And actually, I think it gives us some great insight about where to go looking for stocks if you read it closely. The quote is from Benjamin Graham's The Intelligent Investor in chapter 16. It reads, "In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, 'This too will pass.' Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety." We've talked to you about margin of safety on these calls in the past, but I'll give you a quick refresher. The idea of margin of safety is that you're buying something at a price far less than the value of the future earnings, or even less than the value of the assets of that business. When you buy at the right price, you minimize the risk of permanent loss to your capital. If you look at the first sentence in the passage, the age-old wisdom of "this too will pass" provides a great insight into where to find businesses that possess this margin of safety we're looking for. It's the troubled companies or the down and out sectors. That's where the bargains live. And the astute investor knows the difference between a temporary fixable problem and a permanent impairment. So our eyes are fixed on the areas that are generally less attractive to the entire population. You've seen examples of this in the past year when we've made investments in retail real estate and in the energy sector. Where we don't feel comfortable identifying margin of safety investments is in the industries or companies where everything is going absolutely great. Those situations are almost always priced to perfection, and if everything does not pan out as planned, the investors who bought in at premium prices can be out of the money for a long time. So to tie this back to the overall market comments, we're living in a world of opportunity to make terrific value purchases because there are still problem sectors and bleak outlooks in many areas of the market. Overall, there are only a few areas that we want to avoid because the prices are too high for us, and that's okay. If things do turn quickly and we find ourselves facing another great recession-like period, we feel confident in holding our margin of safety investments because they were purchased at already discounted prices. So our long-term view continues to be that owning equities is the safest way to protect your purchasing power and to provide you and secure your finances for the future. And the good news is we can keep that long-term focus through up, down, and flat markets and continue to prosper. So next slide. So moving into our investment process section of the call, we thought it would be a good time to discuss the importance of a company's balance sheet when we're performing our analysis. Those of you who've been working with us for a long time know that we want to own financially strong businesses, and generally we're looking at the balance sheet to determine that strength. I think it's important to contrast that with the way many other investors perform their analysis, though. For most analysts, the income statement of the business is the primary tool in developing their opinion. So I'll clarify the term balance sheet and income statement so you have a better idea of what we mean when we're referring to it in these investment talks. The balance sheet of a company is essentially its net worth statement. It's a list of everything the company owns and everything the company owes, and to balance those two categories, the balance sheet incorporates a third item, owner's equity. The balance sheet provides us a great deal of information about a given point in time for the business, like the end of the year or the end of the quarter. It tells us all the things about what the company owns and what kind of debt it has, and the document can be especially helpful if you compare it from one year to the next, as it can indicate the trajectory of the overall financial health of the business. Now, the other item that many analysts refer to is the income statement. This document captures the activity of a business over a period of time, say a year or a quarter, and lists all of the relevant income streams into the business and expenses out of the business. The summation of those two items is net profit or net loss for the given period of time. And a lot of investors are interested in seeing a growing bottom line or increasing net profits from period to period. That's how they make their assessment of what will likely continue in the future. Most analysts are valuing a business by discounting those future profits or cash flows to the business and assigning them a current value. The summation of all those future profits discounted at today's dollars is what they think the company should be worth. It's a very interesting way to think about how much a company should be purchased for. But imagine if a company didn't have any earnings, or those earnings were temporarily depressed. How would you go about understanding what the business is worth? Well, we know many investors wouldn't go any further, to tell you the truth, because they're worried about the ability of that business to generate earnings. However, let's just say, for an example, the business is worth $2 billion when we look at all the company assets and it has no debts. And furthermore, let's say you could buy all the company's shares for just $1 billion. Wouldn't it be worth it to look at that business, even if the earnings were not looking good today, to see if there was something more to the story? In our case, the answer is usually yes. In many of our investments, we're looking for scenarios similar to the one I just described. When we look at the companies we're buying, we're trying to identify situations where the business has lots of assets with very minimal debt. Furthermore, it might be to our advantage if the rest of the world isn't so favorable to the business because the income stream that business produces has recently declined or has a bleak outlook. Those impairments to income can be greatly outweighed by the fact that the company owns tremendously valuable assets. The legwork that needs to be done on a company in that scenario is generally to figure out if the decline in income is permanent or temporary. And then we try to make some conservative assumptions about what might happen if that scenario played out over a broad range of outcomes. The companies we're going to review today all illustrate this concept quite well. When we look at their balance sheets, these businesses are on firm footing, with lots of physical assets securing the value of the business. In all the situations, we have businesses that are being purchased in out-of-favor environments and with a fair amount of short-term uncertainty. Nevertheless, our analysis concludes that these are fine investments for the patient, long-term investor who can withstand some short-term humility while their thesis unfolds. Now, Peter and I have had the pleasure of seeing this strategy unfold in our favor dozens of times over the years, and with that, I'll turn it over to Peter to talk to you about the three companies we're going to review today. Peter?
Thanks, Justin. Weyerhaeuser is an investment we began purchasing in late 2010, shortly after the company converted to a real estate investment trust. Weyerhaeuser is one of the largest owners of timberlands with over 13 million acres. At the time of our initial purchase, home building was near the low end of its cycle. The company's revenues had declined by over 60%, and with lumber prices near their bottom, it's no wonder that Weyerhaeuser had lost $1.8 billion in 2008, over $500 million in 2009, and had lowered its cash dividend from $2.40 to 20 cents per share. Weyerhaeuser is a perfect example of why we analyze the balance sheet as well as the income and cash flow statements of a business. In late 2010, the income statement and cash flow statements of Weyerhaeuser were so weak that one could not justify the purchase based on these documents. However, Weyerhaeuser's balance sheet told a different story. The bulk of the assets are timber properties, and that had not changed. In fact, timberlands are consistently growing and thus increasing in value. Together, these factors and a low stock price made Weyerhaeuser an attractive long-term investment opportunity. From the lows in the housing cycle, Weyerhaeuser have gone through quite a transformation. Among the highlights are the following. In 2013, Doyle Simon became Chief Executive Officer. His team cut costs, sold assets, and consolidated some facilities. As CEO, Simon repurchased millions of common shares and raised the cash dividends as the company became more profitable. In addition, his team orchestrated the 2015 merger with Plum Creek Timber, subsequently creating the world's premier timber, land, and forest products company. Now, 8 years later, the housing market is dramatically stronger, timber prices have more than tripled from their lows, and Weyerhaeuser is setting record revenues and profits. A few weeks ago, on August 27th, Weyerhaeuser announced that Doyle Simon would be retiring and Devin Stockfish would be the new CEO. The company is confident that Weyerhaeuser will continue to prosper under his stewardship. While we have held Weyerhaeuser for over 8 years, we continue to hold the shares as we see construction for homes improving for many years. As the bulk of the millennials enter their mid-30s, we believe this massive market in the U.S. population will be in their highest spending years, creating a scenario very similar to the early 1990s when there was a surge in home building. As a byproduct of this, we believe the stock in Weyerhaeuser will continue to appreciate and grow its cash dividend as cash flows improve. Our next company to review is FivePoint Holdings. We initially purchased it in August of last year, and we subsequently added to our position in May of this year as the price of its common stock declined further. FivePoint is an owner and developer of prime real estate in coastal California in 3 master planned communities. The 3 projects include Newhall Ranch, 40 miles north of Los Angeles, the shipyards in Candlestick Point in San Francisco, and the Great Park neighborhoods between San Diego and Los Angeles in Irvine. The original development was conceived in the 1980s by Newhall Land, a management company that created the master plan community of Valencia in the 1960s. During the decades in which the project has been planning, it has faced numerous challenges and several changes in investors. In total, FivePoint plans to sell approximately 40,000 home sites to builders, approximately 21,500 homes at the Newhall Ranch, 9,500 homes at the Great Park neighborhoods, and 12,000 home sites at the San Francisco shipyard in Candlestick Point. As you can imagine, these projects are very long-term in nature. It's anticipated to take 15 to 20 years to complete. To date, the Great Parks neighborhood is well into its development, while the other projects are still in early stages. For example, the first lots at Newhall Ranch are expected to be turned over to builders in late 2019, and the shipyards in San Francisco are still in the U.S. Navy's possession while remediation work is being completed. Due to the nature of land development and sales to builders, we expect revenues to be lumpy moving forward. Therefore, both the income statement and cash flow statements are of less value to the conventional investment analysis. Once again, the balance sheet tells a different story. In addition to the value of these prime real estate holdings, there is over $675 million in cash, exceeding the $600 million of debt. Furthermore, FivePoint is selling land and generating cash that is far in excess of what we're paying for that land as owners of the stock. We think it's important also to look at the ownership. In this case, FivePoint is 40% owned by Lennar, one of the nation's largest home builders, and headed by its former chief investment officer. We feel there's an experienced team in place to navigate the costly and complicated long-term development. And while these headwinds have turned away other investors from taking early action, we feel there are few U.S.-based opportunities in land development with nearly such a great opportunity as FivePoint Holdings. Similar to Weyerhaeuser, we're going into this investment feeling optimistic about the results that we'll experience over the next 5 to 10 years. This thesis will take time to play out, but we're comfortable in knowing that we have a substantial margin of safety in owning such significant land assets. And our final company that we'll take a look at today is Tidewater. We purchased Tidewater earlier this year. This company is very similar to the investment we made in Weyerhaeuser in 2010, in my opinion. The entire industry was down due to supply and demand circumstances. The company had an incredible balance sheet and is merging with another competitor to become the largest company in the industry. Tidewater owns a fleet of ships that provide support to the offshore energy industry around the world. Tidewater was one of the pioneers of the industry in the late 1950s and grew into one of the largest companies in the industry. Back in the early 2000s, the former management at Tidewater made a decision to invest heavily into a more modern and technologically sophisticated fleet of vessels to allow the company to operate in nearly all major oil and gas regions around the world. The decision involved replacing older vessels with new ones, and as you can imagine, it was a costly expansion. The company purchased and constructed 290 vessels at a cost of nearly $5 billion. To finance its fleet, the company used cash flows from the business and borrowed funds. The company's balance sheet became highly leveraged, and when energy prices declined sharply in 2014 through the 2016 lows, the company could not cover the cost of their debt service and filed for bankruptcy in May of 2017. The purpose of the bankruptcy process is to take financially unhealthy businesses and turn them into healthy ones. Some debts are eliminated, some are restructured, and many times the bondholders of the company become equity holders. Basically, bankruptcy fixes the balance sheet. This is precisely what happened with Tidewater and provided us with a list of reasons to own the business. First, the company now owns one of the world's largest and youngest fleets of offshore service vessels. The company has a healthy balance sheet, as a large portion of its debt was converted into common stock. The company will require virtually no major capital expenses for many years to come because the fleet is updated. The company has significant tax loss carryforwards, so future profits will be not taxed for many years. Many of Tidewater's competitors' balance sheets are in poor financial condition with significant debt. This puts a healthy company like Tidewater in the position to merge or purchase other desirable assets when the price is right. And oil prices bottomed in 2016 at under $30 a barrel and are in the recovery phase, with prices more than doubling over the past 2 years. We believe that Tidewater stock sells a significant discount to the market value and the replacement value of its fleet. We love it when we could buy assets at a steep discount to what we think they're worth. The industry still suffers from too many boats and weak demand. In the near term, Tidewater's management goals are to further reduce costs in order to break even and ultimately to return to sustainable profitability. Management is positioning the company for the eventual industry recovery. This July, Tidewater announced plans to merge with Gulfmark Offshore. If consummated, would create a global offshore support vessel leader positioned to capitalize on significant cost synergies. We look forward to seeing how our investment thesis plays out over the next 5 to 10 years. Carly?
Great. Thank you again for joining us on this call today. We received one pre-submitted question prior to the call. As a reminder, we invite you to submit questions prior to these calls so we can incorporate them into our question and answer session. Today's question came in a couple different forms from multiple clients. The question is, what is going on with Fannie Mae?
Thanks, Charlie. Well, this question keeps coming up in our meetings, and I think the answer fits nicely with this call's theme. So as a company, Fannie Mae is in terrific financial shape, and we're waiting patiently for the removal of the conservatorship of the U.S. Treasury Department. In June of this year, Fortune magazine listed the 500 largest companies in our nation. Now, Fannie Mae was number 21 on the list, with over $112 billion in revenues in 2017. And year to date, or halfway through this year, they have $12 billion in pre-tax income. So both the common stock and the preferred stock are trading at a small fraction of what we believe they're worth. The prices are where they are due to the 2012 net worth sweep, which forces Fannie Mae to distribute the profits they earn to the U.S. Treasury. We continue to believe that that arrangement, the net worth sweep, is unconstitutional and unfair to us as shareholders, and we feel it will be reversed by the legislative branch of our government. So we're hopeful this action will take place in 2019. The Trump administration has listed it among their highest priorities in their agenda. It's the last remaining unresolved issue from the financial crisis, and that's now 10 years old. So as with many deep value investments, these resolutions take patience, and we have to be willing to wait to earn our return. Thanks for that question. I did say, as a reminder, we appreciate knowing if you're attending these calls. Please let us know with a quick note, with an email or a text message, that you were on the call or listened to the recording, and we'll aim to keep improving the quality and substance of these calls for you. So your feedback is appreciated. Thanks. Carly?
All right. This ends our question and answer session for today. And as a future reminder for calls, you can send in your questions in advance of the call to any member of our team. We look forward to addressing your future investment questions on these calls, and thank you for tuning in to our commentary on the market and your investments. Thanks again for your time today, and this call will be available for replay within 24 hours on our website.